the Fox 35 Money Watch this morning. Being a successful investor is a tricky thing. There are lots of ways you can invest and also lots of big mistakes that you need to avoid. Bert is here from Certified Financial Group to help you do just that. Good morning, Joe.
Good morning, Tom.
So last week we gave you 1 through 4 on your tips of things to avoid. We're going to do 5 through 8 today, and we're going to start with timing the market. What does this mean?
What this means is you think you know where the markets are going, either up or down.
Okay.
And you know your gut tells you this is a time to get in, there's a time to get out. And this mistake we see time and time again because people's emotions take hold. It's time in the market, not timing the market, that makes a difference.
Okay, and by time in the market, you basically, I think what you mean is put your money in there, ride it out because of the cycles.
Be well diversified and don't look at it every day. In fact, there was a study in the Wall Street Journal a few weeks back that said the more often an investor looks at their portfolio, usually the worse their performance because they think they know what direction the market is going. And nobody knows for sure.
All right, number 6.
Long term, it's up.
Okay. Overpaying in fees.
Well, if you have a modest amount of money, you know, if you're going to do it yourself, you pay nothing. But if you're going to hire a broker or somebody to guide you a modest amount of money, you're going to pay a commission. But if you have a portfolio of $100,000 or more, you ought to be working with an advisor. They can buy you no load, no transaction, no commission fee funds, develop a portfolio for you, and that's a maximum that you ought to pay.
Yeah, we had a company we were dealing with, my wife and I, that and another company came to us and offered us some really great advice and some other things, but then we started looking and they had fees.
Yeah.
And I mean, fees that were rough to take, and so we didn't do it. You
got to be careful. Like I said, if you have a portfolio of $100,000 or more, you ought not be paying commissions.
Okay. Underestimating inflation and taxes.
Oh, this is the one that most people don't think about because it kind of creeps up on you. It goes on in the background, you know. Look at inflation. Look what gasoline was, airline ticket was 10, 15 years ago.
Right.
If you're 65 years old today, statistically you're going to live 20 plus years or more. Do you think the price of gasoline, groceries, electricity is going to be less than it is today?
No.
No way in the world. So what you have to do is figure out that you need more income as you go. So you got to factor in inflation, and taxes is always the killer, you know. Because people don't write a check for their taxes, oftentimes they see money coming back, they think they're not paying taxes. But when you're getting money back, you're still paying some taxes because the government's keeping some of it.
Very quickly,
Sure.
Is there a rule of thumb for estimating inflation?
We use the 3% rule.
Okay.
3%.
Right. And finally, not rebalancing. What do you mean by that?
Well, if you have a diversified portfolio, over time, certain types of investments outperform others. For instance, stocks do better than bonds, foreign stuff does better than domestic stuff. What you want to do is develop a diversified portfolio and sell what's up and buy what's cheap and continue to keep your portfolio in balance. In the long run, that'll serve you.
All right, Bert, good to see you this Sunday morning.
Thanks.
Lauren.
All right, coming up.